I want you to meet John. John has built a multi-million-pound turnover business by buying other people's businesses. And you know the best part? He did it without spending a penny of his own money. Let's find out how he did it. If you're serious about buying a business, then take my brand new, completely free training course. There's a link somewhere up here in the corner of the video. Click the link, take the course, and you could be buying a business in the next 100 days. Like this video, subscribe to the channel, tap the notifications bell, and you will receive a notification the next time I release a new video. We've known each other a number of years.
Yep.
Go back a while.
We do.
You actually said when you were putting the microphone on over there, you said it's your fault, which was an interesting way of.
Well, it is
what's my fault, John?
It's your fault that I've got a current buy and build with a sort of £6 million revenue and 5 independently owned entities. Completely your fault, and I definitely wouldn't have happened without you, and that's a fact. So even though I've been in the M&A space for longer than I care to tell you all, but a long time, 30 years or so, and I'm pretty experienced in buying and selling stuff, either myself or helping other people. And I have known Jonathan a long time, but that's sort of unconnected because we go back to his marketing guild days and so on. But which was the business I referenced earlier, that was the acquisition from the Capital Group and So tell us about these 5. So I didn't realise the other number though. So it's 6 million. Yeah.
Okay.
Yeah, 6 million. So there's six companies. One's been organically grown. One was purchased out of a pre-pack, not our original business. One was a partnership that we purchased through an SPV, and the others were sale purchase agreements, basically.
A share purchase.
Sorry, yes, share purchase agreement. So,
okay.
Brief story is in 2019, I was doing some consultancy work for a couple of clients of mine in their business, which they bought because they thought it was a good idea, but they didn't really know how to structure it. I ended up, to cut a long story short, buying it from them or taking it over from them. And so I had a business, which was the first one I'd had for a number of years because I'd just bought and sold a few in the past. And I think being around Jonathan and then ultimately joining his inner circle to sort of fast forward it a little, made me more accountable. So in any of Jonathan's training, Mastermind is probably the best example where he makes people very accountable. What are you going to do in the next, when you come back here next month, is it all going to be the same, or you're going to check? And that we all need that in life. We all need accountability, and we all need to have reference points, because it makes us better at what we do.
Can I just interject with an example of your personal accountability, that the pressure that you put on yourself, which is, by the next time I see you guys, I will have completed on this business.
Absolutely.
Because you don't want to come along and not have done it.
No, I think it's disrespectful to the peers that you're working with or the cohort you're in or whatever, and I've been preaching that for so long that I could hardly do it myself. So, but I didn't necessarily think through when I thought, I'll buy another business by the time we all meet again, or I'll get to heads of terms on one or whatever. I don't mean it wasn't thought through in terms of I could see I had the deal flow and everything else. What I mean is I didn't necessarily realise the animal that I might build as a consequence of constantly being nagged at to do it by Jonathan, which is a good thing. They're nice.
I wouldn't necessarily use the word nag.
No,
but,
sorry. Yeah, sorry. I mean,
professionally encouraged.
Peer pressure. That's it. Yeah, sorry. Yeah. So but that's been good, and it's been interesting. It's been a good journey, and we're halfway through it.
So I'm not sure if we even said at the start. What do these businesses do?
So construction sector, mainly B2C, some trade stuff, but it's primarily. Think of it as home improvement, so garage door company, roof replacement company. We've got one traditional window and door business as well. So, and we've also got an aluminium fabricator, traditional business. So it's across that sector, and we're looking at all sorts of other areas to add in to get the mix across the group. We're fairly agnostic about what the company is, as long as it's in that sector, sits in that area.
Okay. So tell us about, just pick one of them and tell us about that. One that has some interesting facets to it.
I've got a terrible memory, so I've made some notes. We took over in 2021. That's right. Yeah, in 2021, we bought the second one, having got a business, and then deciding to go off and do a bit of a buy and build, which I have done them before in other sectors, but nowhere near as aggressively as this, and not using all the same tactics that I might have heard before, but Jonathan reinforces so strongly, which made me certainly better at it for sure, personally. So we bought a business, aluminium extrusion business that manufactures products for £500,000 in 2021, or just over. And we paid £500,000 for it, but we deferred 200,000 of it in round figures over 3 years. And the 300,000 came out of the bank of the business that had been established for 35 years, I think. And the owners had obviously built up a nice cash reserve because they like to look at it, as people do.
Okay, let me interject there. So this is a completely new concept that we haven't talked about at all. I don't think it's come up at all today, which is using the cash in the bank of the business that you're buying to fund the acquisition, which the first time you hear it sounds like the craziest. That just sounds like a mind-blowing. How would that ever work? So, John, could you go into a bit more detail about that?
So, although most SME owners don't understand this, once you do, it's a lot simpler. So, assets are assets, whether they're cash machines or anything else. So, whatever's in the bank is an asset of the business. If it's a limited company, it doesn't matter whether the owner thinks it's his money. He's got to get that money out at some level, in some way, and attract a tax charge at that point. So cash, of course, is different to profit. So if you've got cash in the bank, that might have nothing to do with the performance of the business. It may just be reserves that have built up over time. So obviously it's an assessment you do, and it's a conversation you have to have in a certain way, which I think on your mastermind courses you explain it very, very well. And as long as that's had at the early stages and not hidden, because it's not a con, it's just part of the transaction, it usually works pretty well for people because they realise they can release that money, or they can sell their business, including the value in that cash, but pay the minimum amount of tax as well.
Yeah, because we've got obviously business disposal relief, which allows 10% of the first million. It used to be 10 million. Those are the good old days, but now it's only $1 million now.
Yeah.
But it allows you to utilise that cash and give it to the seller, and for them to therefore pay the lowest rate of tax on it. That is pretty, can't get lower than 10%. But allows you to give them something on completion, which means that the balance can be, in your case, deferred over 3 years. Over 3 years. I'm interrupting your video with a very important message. If you are watching a video like this, it's probably because you're serious about buying a business. But watching free videos on YouTube will only take you so far. You need to take the next step. And the next step is a link that's somewhere on the screen up at the top, which takes you through to our free video training. There's no cost whatsoever. You watch the free video training and that will give you some of the essential basics that you need. Now, if you get value from that, then I would invite you to be part of my next Fast Track program. Now, the Fast Track program has been running for a couple of years now. We've had nearly 3,000 people around the world on the Fast Track program, and it's a Zoom program that you can attend from anywhere. It's broadcast from my living room to your living room, where I will teach you what you need to know to go and buy your first business. And there's a Q&A section at the end of each of the training sessions, so you can ask me all of your questions. Now, if you get great value from that and you're really serious about buying a business, then there's my mastermind program, a 12-month program where we hold your hand through the business buying process so that you can buy your first company. And when you have, I'll invite you into our inner circle, which is exclusively for people who've bought their first business. So that's what we've got lined up for you. It's up to you whether you take the next step. Anyway, back to the video. So it's a great example of buying the business without having to use any of your own money. You're effectively using their money. But there's a benefit to them because they pay less tax. They're actually ahead, aren't they?
Yeah. I think it's important with stuff like that. They go off and get a bit of advice, and hopefully they've got an accountant that's competent enough to understand it, because not all accountants are. Yeah. But assuming they get good advice, it's perfectly. Once they understand it, it's fine. It works quite well. But it's the sort of thing you have to bring up very early, I think, because it can cause distrust otherwise. And I think people like Andrew would have done the same thing. You have the conversation early on, whether it's 300,000 or 30,000. They still think it's their money.
The most important thing with all of this is to be transparent. Is not thinking that sort of hiding it, until the last minute, and then sort of coming out with it is a good plan. That is not a good plan. It's to say, right, this is how we propose to do it, that gets you what you want and allows us to buy the business. Yeah. And let me explain to you why this works and how this works. So you sort of, without being patronising, you're educating, aren't you? You're educating the seller on a process that they would never have thought of, unless they've sold a business before, which is unlikely. Can we come to the Q&A a little bit? Hold that question for a moment, would you?
Yeah, and I think just adding to that briefly, I think practice is important. So if you haven't bought a business, just get the letters out and get on with it, and then you can practice on people. And that sounds slightly unkind, but all I mean is get better yourselves. I don't know anybody in life that ever got good at anything without practice. Yeah, people expect to buy a business in 5 minutes.
By watching a YouTube video.
Yeah, by watching a video. Yeah, so not likely really. I mean, there might be a 1 in 10 million chance that you'll land on the one person that knows less than you, but it's unlikely. Whereas if you practice and you know roughly what you're going to say and you keep it formalised and you use Jonathan's guidelines and steps and so on, you will make it easy, because you'll always know more than they will. And that's always a benefit.
Yeah, so if I could just say the same thing but in a different way, which is if you know more about buying a business and the seller knows about selling a business, you're going to be okay. But if you're doing the spaghetti, making it up as you go along, and the seller knows more about selling a business than you know about buying, well, you're going to be outmaneuvered in that negotiation. You might end up buying something without really realising what you're doing.
Yeah, and you're not going to get any trust either, because you need a lot of trust in these things, don't you? Formally, to go forward, both parties need to trust each other, and that's credibility, isn't it, to start with?
It's also professionalism. Mm-hmm. It's doing it in a professional way. So tell us about another one. Pick another one.
So we bought out of, we were going to buy, in a conventional sense, a business in the Northwest that we did some diligence on. So following on from what others have said, I think, it's, again, Andrew, get to the heads of terms really quick. We did that. We don't really get involved in arguing about prices. We certainly never give any offers out. All we say to people is, how much do you want? And by the way, you're not going to get that, so how much do you need? Which is one of Johnson's key phrases. And we shut up and listen, and we pretty much move quickly, because the price doesn't matter. I think other people are going to get up here. I think maybe tomorrow, Phil. He's very simple. It's not really about, at that stage, the price. It's about the viability of the business and what it's worth to you, and what you end up paying for it is a whole different ball game. You start with the heads of terms. That gets everyone else out of the market. From there on in, you negotiate. That's when the negotiation really starts, isn't it? At the point of the heads of terms being signed.
That's a good way of putting it.
Which is why when people email it because they're going to get 98 people to tell them how they would have written it.
There was years ago, I saw this. It was an American piece of research about negotiation, and it was something like 97% of email negotiations fail. So if you think you can negotiate a deal by emailing backwards and forwards, you can't, and it won't work. No. You need to be sitting down with someone face to face. I mean, Zoom's kind of okay, but if you're going to talk about money, talk about it face to face.
Yeah, I agree with that. I mean, I've never negotiated any amount of money in any transaction ever without looking somebody in the eye. You've got to be clear about that, because that's the integrity in it, isn't it? So yeah, Zoom's fine for introductions and stuff, but yeah, key is we did this with these heads of terms with this particular business, and we unearthed a load of nonsense and false accounting and all sorts of other things, luckily, early on. So that are being valued by one of our infamous business brokers, I think they're called, for 350,000 or something, and it was worth probably minus 100,000. So we said to the owners, this isn't going to work. I mean, this isn't for everyone, as Jonathan said. This isn't going to work, but we will help you. And I think we helped them by basically taking the business over by pre-packing it. So that is, we got an administrator involved, a tame administrator in inverted commas, who went through the process of us acquiring the assets, and we paid a nominal sum of money. You know, you don't get any warranties with that. You're buying something unknown, but it's cheap. You know, it's like Gavin will talk to you about his penny deal, and so on.
But the key thing is you've got an infrastructure to pop it into.
Yeah.
Because if you haven't, then it's a lot of work. It's an awful lot of work.
Yeah. And this wasn't completely broken. It was just being badly managed, and clearly financially badly managed as well. And back to the earlier point about it's so important to have your finances in order. And to understand finance if you're going to buy and sell businesses. But we took it over. We did pay a deferred consideration, not a lot of money, but over 4 to 6 months, because you can still do that even with distressed businesses.
Was that with the IP?
Yeah.
It's interesting because most people think you can't. They think that because the IP will tell you that you can't.
Yeah.
The insolvency practitioner will tell you that you've got to pay all the money. We want all the money. And best and final offer, and you've got to, if we accept your offer, we need to complete in 48 hours. And yes, you would have to complete in 48 hours, but people don't seem to realise. I mean, we had in that group, we had the IP come along to the group, that actually they're very open to that payment over time. There's a few sort of caveats to it.
Yeah, and they have to take the best offer, don't they? And that could necessarily be a slightly premium price to somebody else's offer, but paid over a longer period of time, for example. So there's more than one way to do everything, isn't there? But I think we did that. We took it over, sort of transformed it, got rid of all the rot and the people that owned it, who were pretty, who weren't doing a very good job, shall we say, and put the management staff, and as Jonathan says, we had the structure building by then to take that on, because prior to that, we'd just taken on another company not a million miles from it. So we had some of the cross-management skills and things to be able to put in place. So that was a £20,000 investment, but we paid it over 6 months to give you context. And that business probably this year will generate revenues of £750,000 and maybe a EBIT of 60 to 80. These are not high margin enterprises in this space. You know, it's single digit.
So actually, you've got to have scale to turn some decent numbers at the bottom. Yeah. Okay.
And also because the single digit, because success and failure are close. You know, you can be 3% the wrong way or 3% the right way. Success and failure can be, serious. So, yeah, we did that one, and I think the other one to point out to you is where we bought a business for, so I have to get the numbers right, for £235 million a year. These are all between 750 and 1.2 billion pounds of revenue, these businesses I'm talking about, which is where you get your 5 or 6 million. So that one was 235. We paid £155,000 on completion to the two former owners, as they are now. And I think at that moment in time, there was 175 grand in the bank or something. So we did have to put a little bit of money in for working capital, because obviously we do a working capital assessment.
But where did that little bit of money come from?
From the group's resources, not from me, if that's what you mean. So from the group's resources and profits that were already coming to the bottom line. Okay. And the first one I described to you, the £500,000, that is a pretty profitable business historically, and it throws quite a lot of cash off. And we pay about a third of the monthly profits in deferred consideration, and we try to keep that.
That's actually a good ratio. Yeah, so you've got a little bit of headroom if things take a dip. Yeah.
But this one was interesting because one of the many things that when you're in these forums and you're working with people that are in the same kind of game of buying and selling businesses, you learn from each other. So there's been a lot of talk recently, hasn't there, in your inner circles about deferred considerations and the timing of them. Yes. I think you've said more than once, if I look back now, I would have delayed these to 6 months instead of monthly and things of that nature. So taking that on board on this one, the deferred element of it, which was 80,000, no, 120,000. That's right, over 3 years. We did that every 6 months, which is just as well, because we're finding now some accounting problems. And had we had the same issue with one of the others in the past, we would have already been due to pay the first month or two's consideration. So we're in that 6-month period now where we're going to be able to make a very strong case to go to some sort of mediation, as you say, to write that off, because we can see some accruals and things that are inaccurate.
So the benefit to you, the buyer, is not just a cash flow benefit or a capital benefit. The benefit to you, the buyer, of having control over a chunk of the money owed to the owner is that if you have in your sale and purchase agreement a right of offset, you don't have to go and make warranty claims. You can actually offset that amount that's owed against any claim that you might make, as long as it's it's got to be a real claim, which means that you've still got the control. The worst thing you can do when buying a business is give all the money to the owner. They will never be seen ever again. 6-month handover, oh, no, they're on a world cruise. You won't be seeing those guys again soon. People do disappear. They just vanish. The phone number changes and they're gone forever. Sorry for interrupting your video, but I wanted to introduce you to a great lawyer in the UK who can get your deals done for you. He's worked for 50 of my mastermind clients in the last few months alone. His name is John Andrews, and I've got his details right here in my little black book of contacts. You can phone him on 0345 241 2494, or you can email him on johnandrews.dealllawyer@jmw.co.uk. If you want someone who can get a deal done, he is your guy. So let's get back to the video.
So that's another example. So the only other one, I think, probably to give you the picture, is when we bought the garage door business from a pair of partners, or a couple of guys who were in partnership for 35 years, tired, motivated sellers, couldn't wait to get out. Our friends at K3, who are one of many brokers, had valued it at something like 750,000 or something, So obviously we all immediately halve and halve again any of those valuations, but it wasn't worth 20% of that. But they were motivated, and when we asked for the details from the brokers, we were actually told that we weren't a suitable company to acquire them, and that was because at that point we hadn't filed our group accounts with a stronger balance sheet, because we were still putting the structure in. So they had decided, along with the vendor, that we weren't a good fit. So we called the vendor directly, and it wasn't actually the vendor that decided we weren't a great fit. It was the broker. I won't mention again, sorry, but the broker. So we did a deal directly. And we managed to secure that with an SPV for 125,000, with 25,000 down again coming out of the group, 100 grand over 18 months, separately to the two partners, 2.5 grand each. And in each of these cases, the thing I forgot to say is it's a real point for me that I make sure that I take a deal fee out every time.
Good point. I don't think we've mentioned that often, maybe once today, Okay, explain to everyone what a deal fee is. When you acquire a business with an SPV, with a structure, or even the first one, however you're doing it, obviously you own that business at that point. And there's a temptation, I think, when you buy a business, or even when you grow one, to always put off the day when you responsibly realise assets in it. And people that have had business a long time in here will be nodding now, because it's, I'll take a dividend next year, or I'll take more. So one of the things I set in stone when I agreed to kind of get into this journey, through your professional insistence. I like the way you phrase that.
Yeah, that's better. One of the things that Jonathan talks about quite a lot is a deal fee, which is the minute that you have the keys to the door and the bank account, take a consideration out, and I even put them in the heads of terms. So and it goes to my consultancy business. So there's no, again, it's not hiding anything. We even tell the targets that we're going to take it, even though it's nothing to do with them, because we have nothing to hide. We have no agenda, and these are not massive sums of money, and they don't put the business in any distress. But it's always very nice to take a few £1,000s for my time and everything else.
So if I could put it another way, it's pay yourself first.
Yeah.
Where most business owners pay themselves last.
Yeah.
And they pay everyone else, and there's a little bit left in, then that's theirs. But pay yourself first, because you've been the person who's smart enough to go and find the deal, negotiate the deal, put the deal together, nurse it over the line. That was 3 months of your life. Then why should you not be compensated for that? Every private equity deal has a deal fee wrapped into it. It's part of the financing. Because the general partners want to get out a fee for doing exactly the things I've just said. Originating the deal, looking at different deals, putting the deal together, get paid first.
Yeah, I think that is really important. So we're at that stage now where we are consolidating a bit. We do have a bit of deal flow, and we have one more to go to heads of terms in February or March. Not quite, I think it'll probably be March now. Which will take us then annualised up to 7 to 8 million next year. But as I say, it's not a high margin operation. So our target is to get to £1 million of EBIT, which I think is the absolute minimum for choices in the marketplace, whether it be equity, investment, MBO, whatever. All of those things require a bottom line of about £1 million. It's a kind of a magic number.
And just for absolute clarity, I think you said it, but I want to make sure I heard it right, is that all of these deals that you've just described to create this group, how much did you have to write as a personal check into any of these businesses or into the group? Or
No, nothing, zero, nothing, absolutely nothing. Definitely nothing. Yeah, seriously, nothing. Well, I think it's I've got it here. It's with the one that hasn't completed yet. It's acquisition considerations of about 1.25 million. Deferred considerations of payments to the vendors of about 750 round figures, and the balance is all taken out of the businesses that were acquired.
So am I adding those two numbers together? So there's about 2 million in total consideration, or one is includes the other?
Okay. Sorry, yes, one includes the other. It's not very clear, but the key to it is if you structure the deals correctly and you find profitable businesses initially,
that's the key thing.
They will have cash in them. It will be what I call lazy cash. I've seen it all my life where people build up cash balances as if it's some kind of token of success. It's not. You need to make the cash work for you. So when you find those businesses, and it could be a small business with cash in it, it's all relative, isn't it? If it's 100, the construction sector, £1 million business is tiny, but in some sectors, £1 million business is huge. But the key is if you've got 50 grand in the bank, which you might find a small business with, you can definitely use that as part.
So is that your? Sounds to me like that's your go-to strategy.
Yeah, pretty bad. I mean, I don't object to paying, but the main reason why, the main driver really is to defer as much as possible, not necessarily for cash reasons or whatever, because it's a cash-positive business. It's to make sure that you unearth all the nonsense.
So you don't overpay. That's another benefit of deferment, is that you don't overpay.
You never can you?
Can I just give everyone a top tip? When you've got group of a certain size, do a complete refinance of all that deferred, pay off the owners, and turn it into some bank debt. But at the same time, release further cash for growth.
Yeah, and I think that's that's one of the phases we're at now, is looking at finance before we need it, looking at finance to pay off deferred, and get the business sort of debt free in terms of all over the place and into one core element. Yeah.
Top tip for everyone? Anything that springs to mind?
Top tip. I think there's several, aren't there? But try to be succinct. I suppose, as I said to somebody earlier on, choose a sector. I'm fairly sector agnostic. I've been in several of them, but choose a sector that you understand, then understand it better, then understand the multiples in it without getting to, Jonathan has a very good explanation of all that on his mastermind courses where, these are seasoned multiples you can work towards. So, it doesn't necessarily matter along your journey of 2, 3, 4, 5, 10 businesses if you pay a bit too much for one or a little bit less for another. As long as none of the multiples that you end up paying, and you can end up at the figure any which way you like, but in the end it will be a multiple. It's about what
it is always going to be a multiple of something.
Yeah. But when you've actually got to that point where you've got 2, 3, 4, 5, 6, 10 of them, then as long as the aggregate multiple that you've paid along the way remains below the next level when you've got those 5, 6, 7, 8, 9, 10, you're home and dry, aren't you? You just need to find a buyer or an MBO or whatever you choose to do. It's probably easier than people think, that part of it. I think it's the first one's the hardest, isn't it?
It's always the hardest. First one's always the hardest. Let's give John Hood a huge round of applause. Thank you very much, John.
Very much.